For too long, financial literacy has been seen as complex, reserved for the elite. But the truth is, financial knowledge is the gateway to wealth creation, and it belongs to everyone, including you. Whether you're in Nigeria, South Africa, Ghana, Kenya, Rwanda, or the diaspora, the opportunities to build wealth are within your reach. But where do you start? In this documentary, we will break down the fundamentals of money, investing, and financial growth, demystifying stocks, bonds, ETFs, mutual funds, and the world's major stock markets. This is not just information, it's a step-by-step guide to building lasting wealth. Wealth doesn't just come from working hard, it comes from making your money work for you. That's the essence of financial literacy. The rich don't just earn money, they invest and grow it. Income sources can be divided into either active or passive income. Active income is the money earned by exchanging time for money, like salary, wages, or freelancing. Passive income, on the other hand, is the money earned without direct daily effort, such as investments, rental income, or dividends. The goal is to transition from active income dependence to passive income growth. The power of compound interest, they say, is the eighth wonder of the world. Imagine investing $1,000 today with a 10% return. Instead of withdrawing profits, you reinvest them. Over 30 years, that $1,000 grows exponentially. The formula is A equals P multiplied by 1 plus R divided by N to the power of NT. A or P1 plus R N NT. A stands for the total amount that accumulates. P is the original principal. That's the money we start with. The R is the interest rate. The earlier you start, the greater your wealth potential. Good debt versus bad debt. Understand the difference so you can borrow smartly. Good debt. Loans used to acquire assets like real estate, education, or business investments. On the flip on this is the bad debt, which are loans used for liabilities such as expensive cars or lifestyle expenses. For example, taking a loan to invest in a business is smart, but borrowing to buy a luxury phone or take a holiday, not so much. Budgeting allows you to control spending and allocate money toward investments instead of unnecessary expenses. The 50-30-20 rule can be really helpful here. 50% for needs like rent, food and bills, 30% for wants such as entertainment and shopping, and 20% for investments and savings. Tools like Excel spreadsheets, budgeting apps, or even traditional notebooks can help you track your expenses effectively. Stocks, also known as equities, represent owning a piece of a business. So, what is a stock? When you buy a stock, you own a part of the company. You become a shareholder, and if the company grows, so does your investment. There are two main ways to make money from stocks: through dividend payments, where companies share profits with shareholders, or through capital appreciation, where the price of the stock increases over time. For instance, investing in MTN Nigeria or Dangote Cement in 2015 versus their prices today would show significant growth. Bonds and treasury bills are considered safe investments. Bonds are loans to the government or corporations in exchange for periodic interest payments, while treasury bills or T-bills are low-risk short-term investments issued by the government. These are ideal for low-risk investors who want stable returns without market fluctuations. Mutual funds, ETFs, and index funds offer a way to invest without stress. Mutual funds are professionally managed investment portfolios that investors can buy shares in. Fund managers pool money from multiple investors and allocate it across various securities, including stocks, bonds, and short-term debt. Generally, mutual funds fall into four main categories: bond funds, money market funds, target date funds, and stock funds. Each category offers unique characteristics, risk levels, and return potential, enabling investors to select options that align with their financial goals and risk appetite. Exchange-traded funds, ETFs, are low-cost investment vehicles that track markets, sectors, or indices. Unlike mutual funds, they trade on stock exchanges throughout the day like stocks. ETFs offer diversification, flexibility, and tax efficiency while maintaining lower management fees, making them an attractive option for both long-term investors and active traders. Index funds are passively managed investments that track a specific market index, like the S&P 500 or NGX 30. They replicate the index's holdings, offering broad market exposure, low fees, and consistent long-term returns, making them a cost-effective, hands-off investment option. These options are best for beginners who don't want to pick individual stocks. Commercial papers are unsecured, short-term debt instruments issued by corporations to raise capital for immediate needs. Typically maturing within a year, they are issued at a discount and rely on the issuer's creditworthiness, offering investors liquidity and competitive returns. They are typically used by businesses for day-to-day operations. While they offer higher returns than savings accounts, they are riskier than government bonds. What is a stock market? It's a marketplace where investors buy and sell stocks, bonds, and other securities. Stock markets exist to allow companies to raise money while giving investors opportunities to grow their wealth. Major African stock markets include Nigeria NGX, the largest market in West Africa, home to Dangote, GT Bank, and MTN. South Africa JSE, Africa's biggest stock market with international investor participation. Kenya Nairobi Securities Exchange, rapidly growing with tech startups getting listed. Ghana GSE and Rwanda RSE, emerging markets with long-term potential. Major global stock markets include New York Stock Exchange, NYSE, and Nasdaq US. The largest global markets, home to Apple, Microsoft, and Tesla. London Stock Exchange, LSE, UK. Strong ties with African companies. Euronext, Europe's financial hub, ideal for diversification. How to start investing. Choose a brokerage account on your preferred exchange like the NGX, JSE, international platforms. Decide between active trading versus passive long-term investing. Diversify investments to balance risk. Here's a step-by-step guide to buying a stock. Log in to your brokerage platform. Search for the company, like Nestle Nigeria. Analyze the stock's performance. Buy and monitor its progress. Investing in Africa versus investing abroad presents unique opportunities and challenges. Understanding these differences helps investors make informed decisions. Opportunities in Africa include high growth potentials. Many African economies are expanding rapidly, creating opportunities in stocks, real estate, and entrepreneurship. Undervalued markets, unlike US and European markets, African stocks and real estate are still affordable with room for high returns. Growing middle class and consumer market. There's an emerging shift with more people in Africa earning and spending more, boosting demand for businesses and investments. Natural resources and infrastructure development in sectors like agriculture, oil and gas, technology, and construction present lucrative opportunities. Challenges in Africa includes political and economic instability, changes in government policies, inflation, and economic downturns can affect investments. Limited market liquidity. Unlike in the US or UK, African stock markets have fewer buyers and sellers, making it harder to exit some investments quickly. Regulatory and bureaucratic hurdles, business regulations, and investment processes can be complex and slow. Currency risk: the fluctuations in exchange rates can impact returns when investing from abroad. Investing abroad, US, UK, Europe, has its own pros and cons like stable economies and predictable markets, well-established financial markets with lower volatility, access to global stocks and ETFs, platforms like Trading 212, Interactive Brokers, and Hargreaves Lansdown allow investors to buy Apple, Tesla, and Amazon stocks from anywhere. Stronger legal and regulatory protections. Investors have rights and protections against fraud and bad business practices. Higher entry barriers. Real estate, stocks, and businesses often require larger capital investments than in Africa. Market saturation. Competition is high, making it harder to find undiscovered investment opportunities. Tax implications. Investing abroad may come with foreign taxation and complex tax reporting requirements. A smart strategy is to diversify by investing in both African and international markets to balance risks and maximize returns. Sending money securely for investment is a big challenge for Africans in the diaspora due to fraud, high remittance costs, and unreliable intermediaries. Safe ways to send money for investments include official banking channels. Use trusted international banks with branches in Africa like UBA, Zenith Bank, and Standard Chartered. Licensed remittance services. Use Wise, formerly TransferWise, Lemfi, formerly Lehman Finance, World Remit, Sendwave, and DT&T for secure transfers with lower fees. However, you can also use peer-to-peer transfers with trusted people, but ensure you don't fall into the wrong hands. Trust and integrity should be your focus when using peer-to-peer means. Mobile money services. In countries like Kenya, Ghana, and Nigeria, services like M-Pesa, MTN Mobile Money, and OPay allow direct transfers. Blockchain and cryptocurrency transfers. Bitcoin, USDT, and other stablecoins provide fast, borderless, and low-cost transfers. Be mindful of regulations. Investment-focused fintech apps. Platforms like Chaka, Nigeria, Bamboo, Pan-Africa, and RiseVest, diaspora-focused, allow direct investment into African markets. To avoid scams and fraud, always verify investment firms before sending money. Use escrow services or legal contracts when dealing with partners in Africa. Beware of too good to be true investment schemes, such as Ponzi schemes and unrealistic returns. Fintech is revolutionizing investment in Africa, making it easier for Africans at home and in the diaspora to invest, save, and grow wealth. Key ways fintech is changing investing in Africa include stock and crypto investment apps. Platforms like Bamboo, Chaka, Trove, and Eversend allow users to buy US and African stocks with ease. Crowdfunding and peer-to-peer lending. Apps like Thrive Agriculture Investment, and Fund Bay Group Savings provide alternative ways to invest. Mobile money and digital banking services like M-Pesa, Kenya, MTN Mobile Money, Ghana, Nigeria, and Flutterwave, Pan-Africa enable instant transactions. Decentralized finance, DeFi, and blockchain. Some startups are exploring blockchain-powered financial solutions for lending, saving, and trading. The rise of fintech unicorns like Flutterwave and Paystack proves that tech-driven financial solutions are the future of African investing. Those who leverage these platforms early will benefit the most. Investing in African startups and fintech through crowdfunding and angel investing opportunities is booming in Africa, with fintech, e-commerce, and agriculture leading the way. But how can Africans in the diaspora tap into these opportunities? Ways to invest in African startups include angel investing. Wealthy individuals invest in promising startups in exchange for equity ownership. Crowdfunding. Platforms like Thrive farm crowdy, and get equity allow small investors to fund businesses and get returns. Private equity and venture capital. Some firms specialize in funding African businesses with high growth potential. High growth sectors for investment include fintech, banking, payments, loans. Example, Paystack acquired by Stripe for $200 million. E-commerce and logistics. Example, Jumia, Africa's first NYSE-listed tech company. Renewable energy and infrastructure. Example, M-Kopa, solar energy solutions in Kenya. Agritech and agri-finance. Example, Thrive Agric, connects investors to farmers. Tip, join investment groups, angel networks, or crowdfunding platforms focused on Africa. Meet Ade, a Nigerian living in the UK. Ade moved to the UK in 2005 and started working in IT. Instead of spending all his earnings, he saved 30% of his income for investment. In 2012, he bought 2 rental properties in Lagos at 10 million naira each. Today, each property is worth over 60 million naira. In 2018, he invested in a fintech startup through angel investing. The startup later received $5 million in venture capital funding, and Ade's shares grew 10 times in value. In 2022, he launched a poultry farm in Ogun State, providing jobs for locals while earning passive income. Lessons from Ade's story. Investing back home requires strategic planning, patience, and the right networks. Diversification is key. Real estate, tech startups, and agriculture helped Ade build lasting wealth. Leveraging local expertise, hiring property managers and business partners helped him avoid mismanagement and fraud. Ade's advice to Africans in the diaspora: start small, but start now. Don't wait for the perfect time. The best investments take years to grow, but the earlier you plant, the bigger the harvest. The future of African investments is bright. Whether it's stocks, real estate, startups, or fintech, opportunities abound. But success requires education, patience, and the right strategies. Now that you have the knowledge, the next step is action. The journey to financial freedom starts with a single step, whether it's saving, investing, or committing to learning more. Will you take action today and secure your financial future? Join the challenge. Make your first investment, whether in stocks, real estate, or a small business, and share your journey in the comments. Subscribe for more. Stay updated on financial education and wealth building strategies. Follow and connect. Join our investing community on YouTube, Instagram, Facebook, and TikTok. It's Maloney Street Read to stay inspired and informed. The best time to start was yesterday. The next best time is now. Let's build wealth together.